I can explain why it always feels like you lose money when it comes to investing. Some of you guys may be so jaded with investing that you're so scared and you're using just fixed deposits. I can explain that because I'm producing this to address questions from private clients, and I think some insights might be useful to really clear up the air when it comes to this subject on investing. And more than just that, I'll be showing you solutions on how you can remedy that perspective. So believe me on that and continue watching on. This is what I'll suggest to simulate what could happen moving forward, because I see resemblance between the markets right now to back when we had the dot-com bubble crash in year 2000. We use S&P 500, which can be tracked by SPY ETF, and we'll start the investment journey back in January 2001 for this whole simulation. So follow along with me in this story, and it goes like this. Your advisor recommended that you start investing. US equities and tech have done well in the last few years, and there's good reason to believe that you can actually get returns by being invested. To be prudent, you guys started the investment journey using dollar cost averaging, putting in $1,000 each month to buy SPY ETF. Again, that tracks S&P 500. When you buy a broad-based index, the good part about it is you'll never become zero. That is true because you're investing in the biggest companies in the world, and it's just a function of waiting out. It's just a function of time. And after all, S&P 500 has experienced such good rally in the previous few years, and this downturn could be an opportunity. The internet is going to change the world. That's what the perception is in year 2000, correct? Technology companies were the biggest beneficiaries that's going to reshape this world. And of course, we've heard so many stories of people becoming rich with technology. In these 2 years, the stock markets actually continued to drop. This is how it will look like, dropping all the way from 1,200, which is where you entered, all the way down to 900 plus. But because you didn't do lump sum investing, you only invested $1,000 each month, your results look actually like this. And in some periods, your P&L, profit and loss statement, was actually positive. Versus a lump sum investment, at the end of 3 years, there is massive outperformance and with less volatility. But you'll still be staring at a loss, simply because the markets are still down, correct? Your portfolio will now look minus 17%. But if you put everything in right at January 2001, you would be minus 30% instead. So not too bad after all. If you're new to investing and you're committed to investing bigger sums, then definitely be diversified and dollar cost average. These two would keep you safe and allow you to ride out the investment journey and sleep well at night. Hopefully at that point of time, the advisor has advised you to stay the course and commit to the long term. Let's fast forward 5 years because there's sunshine at the end of the day, correct? Now, your total investment journey is 7 years plus. We look into the world of October 2007. Voila, big gains, correct? Right now, your portfolio stands at 30+% gains and it still outperformed lump sum investing at that post-crash period in 2001. Is it time to celebrate? Maybe, or maybe not. The reason is this. At this point of time, the markets are exuberant. There's actually this fear of missing out, FOMO, which was actually experienced back in 2001. And what happens is that usually we start to compare with someone who has actually gained way more. If you check around forums, you see people bragging that they have gained $2,000 versus $10. Not just that, someone who has started the investment journey in 2003 instead of when you started 2001 would have outperformed you massively. And a further point to add, someone who only started the investment journey in 2005 with a lump sum would have experienced the same return you have gotten doing dollar cost averaging for 7 years. That is why also some people say lump sum investing is better. And on the uptrend, that's of course. In 2+ years, an investor will have raked in 30+% in this scenario. So think about this. FOMO, correct? Fear of missing out. Markets are on the uptrend. When markets are uptrend, it's best to do lump sum. Not just that, at this point of time, maybe there's some career progression. Big payday, big income. A lot of savings built up already. As we age, we all go through this phase. When we start investing, we don't have a lot of salary. But then once we started investing for 10 years, our salary also increased because we have been promoted in our careers and we're doing well. And that's where we have new and bigger monies to pour in the markets, and that actually means we restart the cycle. That's actually seldom mentioned. So I've actually done the math to show you what happens. At this point in time in October 2007, you own actually 697 units of SPY ETF, which represents again S&P 500 at an average price of $115. Assuming we want to double that investment, we have to buy right now 697 units at $153. That means, all in all, you own 1,394 units of SPY ETF in the portfolio after this lump sum purchase. The average price, $134. Whoops, that turned out to be close to the market peak. What happened was global financial crisis, correct? And markets actually came down. The gains you have experienced was fully wiped out as early as start of 2008. And thereafter, the portfolio sank badly into the red. At this point in March 2009, the portfolio would have lost $83,000 plus. And this feels a magnitude bigger than what you have experienced in gains back in 2007, where you clocked in $27,000 profit. Hopefully at this point of time, you are a bit more affluent. You don't need to sell out of panic. And markets actually started to recover. And by end of 2010, you'll be close to break even. The P&L will look minus 14,000. That clocks a 10-year investment cycle. What has actually destroyed the portfolio? What has actually caused the losses that's been experienced? It's quite simply, again, the fear of missing out in 2007 when it was close to the peak. Waiting 3 more years past the peak and the portfolio is still negative. In total, the 10-year investment journey now has become negative. And this can cause anyone to feel disheartened about investment markets, simply with the effect of loss aversion. I once made money and now I've lost money. 27,000 gain after 7 years of waiting. I put in more and now I'm stuck with minus 14% after 10 years. The feeling of that loss is now weighing even more than the good feeling of that gain. And not just that, if you think about it, if you had just simply put all your monies in the fixed deposits, you wouldn't have lost any money, correct? Your principal will be intact. So if a simple calculation, we imagine 200,000 investment, if 2% interest is experienced for just 3 years, that would mean 6,000 plus in terms of gains, correct? All this hassle of investing for what? It didn't even beat fixed deposits. Question is, why didn't we buy the fixed deposits back in 2007? Think back again, FOMO, correct? Fear of missing out. People were making double-digit gains, while fixed deposits at 2%, that's just too pathetic. We all know the saying, you can't have the cake to look at it and also to eat it. So that ties into Warren Buffett saying, be fearful when others are greedy. Now I promised you solutions, correct? And let's start with a simple one. Stick to the dollar cost averaging. Good times and bad times, just stick to it. That at least removes away the greed. Because if you have continued that journey of $1,000 per month, even though markets were euphoric in 2007 and crashed in 2008, you would actually be positive already in 2010. There would have been a $10,000 plus gain. But again, if we see from a different perspective, invest for 10 years and only $10,000 gain from $117,000 capital. What's the point? What are we doing? Investing in property would have been better, correct? Now that's a great question. And I'll use this to explain. It's very easy to have confirmation biases. If you believe everybody's making big monies in properties, you tend to seek out stories and information and remember only details of people who have made monies. There's just an aversion to read stories of people who have lost big in properties when they speculated and couldn't hold on to their properties. More than that, it is very difficult for anyone to do the math to really count out how much profits there are after removing away interest expenses. Because again, a $100,000 gain in property, if you have paid taxes and interest costs of $110,000, net, there will still be a loss of $10,000. But point number 2, which is actually more important, isn't property a long-term commitment also with a monthly payment? If you think about it, anyone who doesn't have the holding power and sold off when markets were bearish would definitely have a bad experience. And the journey of paying mortgage, there's also pain to it. So these are 2 factors to think about when we compare investments and properties. And as always, if you have questions regarding this topic, leave them in the comment sections, smash the like button so that we can reach a bigger audience together, and press on the subscribe, especially if you like content like this that helps you in your investment and retirement journey. And since you start with me to here, I promised you solutions, correct? And let me give you a more advanced one. Why not instead increase your dollar cost averaging in bear markets rather than punting lump sum when markets are looking bullish? Of course, you have to stay optimistic in bear markets. That's without a saying. But the whole idea is when markets are bearish, you start acquiring assets and start thinking with a contrarian view. Let's use a simulation also. For example, markets started to come down in 2008. And let's use the example of October 2008, whereby markets haven't actually reached the bottom but has declined quite significantly. This is a period to get greedy when others are fearful. But of course, at this point of time, your portfolio will also be negative already. But no risk, you've seen before market cycles, and the gains will eventually come back. Right now, your average price is $104 with 884 units of SPY ETF. If you double it, your purchasing price right now would be $88, which means your average price would now be $96, with total units now of 1,768. I can't simulate a dollar cost averaging here, so instead I can put in lump sum, but you see the idea. If you dollar cost average when markets are bearish, you double down then, your portfolio can easily, putting in for example $80,000, you break down into 8 months of $10,000 each, your strategy will be able to help you pick up when markets are bearish. And by the end of 2010, you realize that your total portfolio now will sit with a gain of $54,000. Again, the simulation is if you have done a lump sum in October 2008 instead of doing 8 months of $10,000. Your results with a dollar cost average in bear markets would have been even better than this end result. Hopefully I've clarified some things, and investment values going up and down is just part of the market cycle. And as always, if you learned something, smash on like, and I have this question to round things off. With a capital invested of $195,000 and a portfolio value of now of only $250,000, total gains of $54,000 plus, correct? And an investment journey of 10 years, why does it still seem that the rate of return is so low? Is it really only 20% over 10 years? Or there's an error in the assumption of rate of return? Does it seem a bit weird? Because this is a question on internal rate of return. If you know the answer to explain things, leave them in the comment sections. I'll be keen to see who has gotten the right answer too. With that, I'll sign off from here and invite you also to this tutorial I've done. How to invest, because this shows markets ups and downs. If you're a new investor, I think you can really benefit from this sharing. Then I'll sign off from here and see you there. Take care as always. Goodbye.